Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby Kinzer,
And I'm Thomas Doty.
and we are the FITT Show, financial information for today and tomorrow, helping our people get their finances in shape. Today is Thursday, June 8th, 2023. We'd like to thank everybody for joining us today around the country and around the world. We really appreciate that. Last week's show, it was, does it pay? Does reward cards pay? And I hope you see from our show that we found out that they did, but you need to be careful and understand, like we say about everything, whether it's the stock market, whether it's your corporate financial, your corporate 401k plan, or reward cards and credit cards. You need to understand and know what you're dealing with, and that's the bottom line. So, Dote, how are you doing today?
Man, I'm so happy to be back home, chasing my grandkids around for like 12 days. Wore me out.
Wow, yeah. And how old are they again?
They'll be 8 and 5.
Oh, now that's enough to wear a person out. That's enough to, especially at your age, man. Chasing kids around, that's a wonderful thing, man. So, Dote, lots been going on in the world. This crazy wildfire smoke coming from Canada into the East Coast. Are you affected by any of that down there?
No, we didn't see any down here, none at
Yeah,
all.
we got it here, man. It's a little hazy, and it's actually was the worst air quality um, in the country. Actually, they said in the world. It's pretty wild. So with that, Dote, we got an interesting show today, and the title is "Do-It-Yourself Investors' Biggest Mistakes." I'm looking forward to this one, Dope, because a lot of people need to learn how to take control of their finances, but sometimes you got to make sure if you do that you're doing it right. But let's start off like we always do at the top of the show. Let's go to say, let's go to the stock market,
Yeah,
our
and
favorite place.
it's been another crazy week. Still, everything is still moving positive with the debt ceiling being settled, and it looks like the Fed's not going to raise interest rates. The Dow is up a couple percent over last week, 772 points. NASDAQ's up 138 points. Microsoft is actually down for the week, but it's up 41% for the year. So there's going to be some up and down with that. But I mean, being up 41% for the year, it's still pretty good. It actually hit its 52-week high of 338 during the past week and settled in at 325. Tesla's the big mover this week. It's up 27 points. Tesla's actually up 15% in June. In June only, just in June, it's up 15%. For the year, it's up 90%, which is just crazy. And there's a couple of reasons people think, nobody knows for sure. I think two of the bigger reasons, number one, with their price cuts and the way they've done their battery deployment, as far as what they put in the cars, they now qualify for the full $7,500 tax credit. Okay, and it's really crazy when you think about it. If you buy one in California, they have a pretty big tax credit, in California. Between the tax credit you'd get from California and the U.S. federal government, you can buy a Tesla for less than you can buy a Camry, which is absolutely unbelievable to me. Now, if you're not in California, obviously it's going to cost you a little bit more. But still, just to think of the price being in the 20s, I think it's like 27, 20, somewhere around 27 with the tax credits. But and obviously a little higher if you're not in California. But the price is still coming down. They're betting on pushing volume, and that's why they keep cutting prices. And the other big thing is the Cybertruck. They expect to deliver that this year. And the street was only estimating that they would sell like 100,000, but right now they're looking to sell 375,000 units next year. So that's another big reason why the stock is moving. But as I said last week, this stock is so volatile; it's liable to drop 50 tomorrow. So it's no telling what's going to happen with Tesla. But right now, like I said, it's up 90% for the year, and 15% for June, so it's going really good. Apple's only up $1, but it's still hanging in there strong. They brought out their 3D glasses or 3D camera glasses kind of thing, and it kind of you look at your photos and it makes them look fantastic, and you can see things in 3D. It's a little pricey, but a lot of people were impressed by it. And even Pfizer went up $1 this week, so it's a pretty good week for everything but Microsoft. But like I said, Microsoft's up so much this year that even that's a good story. So not a bad week on the street, Bob.
Though that NVIDIA stock,
Oh, it's still rolling, man.
semiconductors, is up $10 today.
Yeah, but it fell back, so it's still. I mean, it's still doing good. I've more than doubled my money on that one. I'm really happy with that, and I hope it keeps going. I truly do.
Yeah, well, I'm really considering that stock though. I think it has very promising, man. Even though it's been kind of volatile the past few weeks, down by 10, up by 10.
Well, AI is the stuff right now. Everybody's between Google, Microsoft, NVIDIA, and a couple other companies. They're really in the
XP.
Yeah, they're really in the forefront of that. So
Right.
now's the time to be in it.
Yeah, because I told you I'm with that stock out of Holland called NXP. They're not as big as NVIDIA, but they're up there in $1 billion in revenues. They're in semiconductors and almost all the cars to work the computers in the cars, Mercedes, Lexus, things like that. Hearing aids. It's really interesting how that stock has been going. I'm up double myself too, though, on that. For
Yeah.
my engine. Another thing, though, my supercharger stock, OZAP, man, that's up 17%. Even though it's just selling at 68 cents a share, it's up 17%. So,
Nothing wrong with that, man.
yeah, it's moving. Keep my eye on those things. So, let's talk about one of my favorites. And though I must admit, it's becoming less and less of my favorite. Cryptocurrency market is down by 28 billion, the total market cap, which is $1.1 trillion, down 2%. The Bitcoin is down about $332 a Bitcoin, ending at around about 7 o'clock at $26,558 for one Bitcoin. And remember why I say 7 p.m.? Because remember, cryptocurrency trades 24 hours a day, so it's constantly changing its price. It's down just 1%. Ethereum, the smart contract, is down about 1%. And Dogecoin is dropping. It's dropping down. It's dropping, even though it's holding 7. That's just rounding, because now it's at 0.069. Actually, when I peeked at it again, and then look at Shiba Inu. Shiba was at 15. Now it's down to 17, though. I don't know, though.
Zeros.
Well, I don't know, but I think it might be safe to say that Shiba Inu is on the chopping block.
Oh yeah.
It's just been going down and down. It's that meme coin, that meme cryptocurrency coin. It's like a picture of a dog. It's actually like of a dog, an Indian dog, East Indian dog. So that's it for the cryptocurrency market, though. Once again, we like to say, it's all about holding, all about the long play. It's just never know about this. If you got in, and if you need the money, you got to do what you got to do. But if you don't, sit patiently and keep your eyes on it, So, let's get into our subject today. Do-it-yourself investors' biggest mistakes.
Yeah, and an interesting subject. This kind of caught our eye because our whole goal is to get people to have a basic understanding of how to handle their finances and just trying to increase financial literacy. And as Bob and I talked about it, when we grew up, we didn't really put any time into financial planning. Again, the only conversation about money was we didn't have enough, and and so we don't really have experience handling money, and people don't put a lot of time into it. And so what happens is you don't put the effort into it, and you get out of it most things what you put in. And so we'd like folks to take a personal responsibility with their financial decisions, get involved, put the time in. And in the past, we didn't have a lot of help. Nobody really, most of us couldn't get help from our parents. And so, but right now, there's no excuse for that. There's no reason why you should not take control of your financial situation. There are so many places you can look at. You can watch our show. Hopefully, we give you some ideas about what you should be doing, and a lot of places to access information. And that is an ever-changing situation because your situation changes. You don't make the same decisions if you have $1,000 that you would make if you had $5,000. So as your situation changes, you need to expand your knowledge, continue learning, looking forward to the future, and making sure you're on sound financial footing. And we've always said you don't have to have a degree in finance to do better with your money. You just got to be willing to put the effort in, do some research, and really take that personal responsibility of, I need to know my financial situation.
And don't, like you said, you don't have a degree in finance or be some great financial guru. Like you can manage your own finances with a little research, effort, patience, and just common sense. You can do it yourself. But just remember though, sometimes doing it yourself can be as bad as doing nothing if you're not doing it the right way. That's what we talk about all the time, at least trying to understand and have the right tools and information in front of you so that you can make the good financial decisions. In addition, there is empirical data evidence that you don't have to have a financial advisor too. Although we talk about having a financial advisor, but there's empirical data out there that says, actually, though, according to a 2020 report, over a 15-year period, 90% of actively managed investment funds, that's like mutual funds and different than index funds, they fail to beat the actual market itself. So today we're going to discuss some of the most common and costly mistakes that do-it-yourself investors make.
Yeah, and as we go through this, a lot of this is our opinion. So take that into consideration. And the first big one is a lot of do-it-yourself investors have a tendency to purchase whole life insurance. And a lot of that is from what we learned when we were growing up. I think most people remember the insurance man coming once a week to collect the money for the insurance policy. And they promised a cash value. It had an insurance part and an investment part. That investment part was grossly inadequate, I'll say. And typically the best thing about whole life was it paid a healthy fee to the guy who's selling it. And you're much better off, in my opinion, keeping those two things separate: insurance versus investments. It gets confusing when you put them together. You can end up making poor decisions on the total product if you don't separate them. But you buy insurance for a particular situation, to replace your money if something happens to you, to replace your spouse's money if something happens to your spouse, and to make sure your kids or whoever you're leaving is going to be okay for a specific period of time. And investments is something completely different. When those two are intertwined, it gets confusing. And again, it pays a pretty healthy premium to the guy who's selling it. And the fees are are pretty extensive. So, and that's why it was always pushed in the Black community, and that's where we are. But it's one of those things you got to look at when they start putting things together. You got to separate them and make sure the price for each is reasonable.
Well, that's one of the things they did with insurance when they came from the traditional insurance of whole life insurance, guaranteeing you like a 4% cash value. And then they came with the hybrid of adding so you can get a greater return to the market. They add insurance to the market, which is called universal life insurance.
Right.
And now they have another one called index universal life insurance, where
Yep.
they tie to an index fund. And like I said, where I was talking earlier about actively managed funds, which charges a little bit more because they managing, taking stuff in and out. But index funds, they just tied straight to the market. It doesn't make as much as actively managed funds, but it's steady and it follows what the market is doing. But I want to talk though. Another mistake that people make is not contributing to their 401k plan because the employer doesn't provide a matching contribution. For instance, like people who are civil service or CRCS, what people know that as, they don't get, like some companies like the FDIC, they let you still put money in the 401k plan, but they don't match it because you're civil service. Some people don't have, so they just don't get into it because they're not matching. But you need to appreciate the power of tax deferred money. So even if they don't match it, and this is another mistake that people make though with their 401k plan, especially the thrift savings plans, the TSP. A lot of people put the match and they set their 401k plan automatically on 5% to take out 5% to match what the FDIC in this case provides, right? But what happened is if your salary goes up, if your salary goes up, that 5% may be less than the total amount that you can get that you're allowed to take out for a 401k plan, which is about what, 19,000 now,
Somewhere
and
around
the catch up about 19.5, but with the catch up is even more. It's almost close to 30,000. So, but what people don't know though, by putting the percentage, it will not reach the allowed amount that you can write off on your taxes. Let's say it's 19.5, but if your salary goes up and the 5%, that 5% might just be 18,000. But because it's in the system, it'll stop automatically, and people are not getting the full match, which is another mistake that people don't realize it. And I hope y'all understand that. And if you don't, put something in the box and I'll explain it clear. But a lot of people miss that because they set it at a percentage as opposed to an actual amount, so they don't reach the total amount that they're allowed to deduct on their taxes. So beware of that. Finally, one of the biggest risks, though, the high net worth individuals tend to face is concentrated stock risk. Now, there's a lot of people who work in the tech learn that you can purchase a company stock at a discount and from the prior quarter or 6 months. So a lot of people who work private in the private industry and corporation, they can actually have stock options. They can buy stocks from their company. Now they think that's a great deal, which it is, and they start to divert a lot of their funds into the employee stock purchase plan. Even worse, they may forego contributing to a 401k plan to contribute more towards a stock plan. So they get stuck with both concentration risk and employee risk. Since the job is tied to the employer, if anything happens to the employer, that could seriously affect your financial future. So, consider that, do a little bit of both. Don't be so highly concentrated in stock options if you're in the private world. It's good to have that, but it's also good to diversify, to have an IRA or to have a 401k plan if they offer that too.
Yeah, another area where people tend to mess up, and especially younger folks, is don't really understand the tax impact of if they happen to hit on a stock and have a gain, or if they're doing a lot of transactions, there's a lot they can do as far as harvesting, offsetting gains and losses, making sure you hold it, if it's possible, hold it longer than a year to get advantage of long-term gains. And if you can offset it with a loss, then you can do that and come out ahead. And you can give a lot less money to Uncle Sam and your state in a lot of cases just by making some sound decisions when it comes to taxes. And another area is that a lot of people don't take advantage of IRAs, and the smart people do. They put money, defer it, and you reach a point where you don't want to have too much money deferred because eventually you got to pay the piper. But that's when you get it into a Roth. And if you put your risky stuff into Roths, okay, then you aren't paying taxes on that. That money is just growing at a much faster rate than if you had it outside of an IRA or Roth, where you have to pay taxes on it. And so, and this is really when you get into understanding where your money is, and you want to have your risky money, obviously, in something that's tax protected, and your more conservative money, you might have that in something that you do have to pay taxes on. But if you are spreading your risk, making your risk tolerance is saying I should have so much risk, so much stable, then you want to have your stable money paying taxes on that, and your risky money, you want that tax protected. So a lot of that people don't get into, again, because it's complicated, takes a lot of work to figure out, and you have to stay on top of it to make sure things are going like you want them to go.
Though our comment box is blown up because they just federally indicted Donald Trump on the classified documents.
Yeah, I don't care about that.
Yeah, but
the question, then I'll be happy.
Well, but I only brought that up because the question came up was, how will the stock market react to former Donald Trump's indictments? We usually don't get involved with political issues, but who knows?
Let's not. Let's stick to finance.
Yes. But I know a lot of people are saying, I just want to address it because a lot of people are blowing up the comment box. And I just want to tell you, we don't get involved with political issues. We try not to. Let's put it that way. Though I want to talk a little bit about another opportunity that's often missed. And it's often missed by the Henrys. You ever heard of the Henrys, though?
Yeah, I got a couple of them in my family now.
Yeah, they're high earners, not rich yet. And that's the Henrys. So and the Henrys have to do with health savings accounts. Now, this is an interesting concept, though, so I hope people stick with me. Now, health savings accounts is actually the best investment account that anyone can have, different than the flex accounts, which they don't roll over, right? You got to use that money or lose it in the flex accounts. But in the health savings accounts, you can leave it in there and it can roll over, and you can use it too eventually, right? The earnings part you can use, but it doesn't matter if you're young or old. What matters is having time to compound the money in the account. Now, health savings plans grow and compound better than Roth IRAs. The money goes in, compounds, and is taken out all tax free. But a lot of people fund health savings plan and they don't invest the money because they use it. Now, you should not use it for, and this is one concept, though, that one of these advisors came up with. Is saying, think about like not using the current medical expense, not using the HSA for your current medical expenses, unless you ultimately don't have the earnings power. Because remember, we talk about high earnings people, right? So should you have, unless you ultimately don't have the earnings power and you need the cash. But this other concept is the health savings account should be funded to the max and not use, and let as much as you can compound in there. And you find cash flow somewhere else for your annual medical costs and needs. Obviously, if you need the money to pay your medical expenses, no question. But if you're a Henry, you're high earners, and you're earning a lot of money, this concept, and this, what do you think about that, though?
Yeah, it makes sense. Again, it's kind of what I was saying before. You want to have, and if you do invest and you're given an option to invest in something, let's call it a little bit risky, this is where you do it, where if you do hit, you don't pay taxes on it, which is that's always good.
You breaking up, though. Can't hear you.
I don't know what happened. But
No, it just was one of those glitches. You can go. I can hear you now.
no, I'm saying it's like we talked about before. It's you want to have that money that you have invested tax protected or tax sheltered in something that might be a little more risky than normal, because if you do get a big gain, you don't pay taxes on it. So you're much better off to have it to invest it in something that might be a little riskier than you normally do.
Right. So
Okay.
the next one's on you, though.
Yeah, next one, and that's diversification. And we've talked about how important it is to diversify. But I think people think because they buy a lot of different stocks,
Right.
that guarantees diversification.
Right.
And just add more individual holdings or funds or EFTs, that doesn't guarantee you that you have a diversified portfolio. So when you talk about, diversification, what you're really talking about is being in different sectors of the market. Okay, you can talk regionally. You can have money invested in the U.S. versus Europe versus Asia. That's a regional diversification. Then you can have it by sectors. You can be invested in technology. You can be invested in the auto industry. You can be invested in, like Bob always talks about, Procter and Gamble's and in those types of blue chip. So when you think about diversification, you really want to you don't want to just buy a whole bunch of things and then think you diversify. You really need to think through it. And so make sure you are in something that if one particular segment goes down, that usually bodes well for a different segment. So you kind of make money no matter what the market is doing.
Right. My sister Nola is into human resources and deals with a lot of benefits. And she was talking about the IRS limits on the health savings plan at $3,850 maximum. But and hit me in the box, Nola, if I'm right. But you can roll that over to the next year, correct? And let me know if that's correct. And I think it starts again another 38.5. But hit me in the box, Nola. Let me know if that's correct. No, another thing, we want to talk about diversification, right? Well, diversification comes from adding positions that are good, high quality investments, but they have varying degrees of correlation. Now, proper diversification needs to be intentional and it needs to be monitored over time to make sure that you remain diversified. I liken it to when people buy a piece of clothing and they put it in the closet and they don't get rid of it because at one point they liked it and they continue to add more and more stuff to that closet, right? Stuff they buy, and eventually they look in their closet and they find they have a ton of Hawaiian shirts. And that's true with our portfolios as well. It's easy to add positions and a little bit more challenging to remove them. Sometimes we hold some stocks, though, longer than we should, and we don't take advantage of the tax harvesting. And we can talk about that later, but sometimes you got to know when to hold them and know when to fold them.
Yeah, and the other thing is sometimes people get so concentrated in one area. You talked a little bit about it when you talked about your 401k is with one company, is with the company, and your employment is with that company. So if something bad happens to that company, your financial life is ruined. But some people do that with stocks, and as much as I love Microsoft, I would never put all of my money in Microsoft, where I would be totally concentrated in that stock. And that was what happens with a lot of employees. they'll end up with a lot of money in their company stock. And because a lot of times companies pay their match with stock, and they end up with so much in that stock where if something bad happens, it kind of beats them up. And so, like right now, everybody's thinking AI. So you don't want to go out and just put all your money in artificial intelligence stocks.
Right.
It would be good to have some in there, to have a piece of your money in that segment, but not all. Even though that seems to be hot right now, it could fall on its face tomorrow, and you got to be ready for that. And so, always try to make sure you look at it again regionally, look at it by sector, and then even within sectors by individual companies as far as what they do and what they don't do.
Well, Nolia made another statement, and by the way, she confirmed what I said, that 38.5, 3,850, you can roll over to the next year and roll it over. Then she says, health savings plan can always take it with you if you resign or take a new job. Health savings are great for retirement savings. Thanks for that, Noli. She's a benefit specialist, been that for years, a director. Thanks, Noli, for that information. Kitty Cheney. Now, Kitty has a TSP. She's an FDIC employee. She also has the T. Rowe Price FDIC matching 401k plan. We're so fortunate. Kitty says, my TSP went up $11,000 in the last 10 days. The T. Rowe Price, $5,000. Good for you, Kitty.
Yeah.
And that means one thing. Kitty's rolling the dice. You must be in growth fund, Kitty. I ain't mad at you.
Right.
So next thing I want to talk about is you may need a financial advisor. Now, we're talking about do-it-yourself investors, which we encourage that you understand and get a handle on your own money. But we also know that you may need a financial advisor. You can have a financial advisor that can keep you between the guardrails. That's the benefit. Because sometimes, we get our emotions all tied into it, and we be wanting to jump out of a stock and jump into some other stock because it's the expectations from somebody else that told us something about it. But a financial advisor, even if you're doing it yourself, get this straight, it's okay. Just because you're doing it yourself don't mean you can't have a financial advisor. Doing it yourself means that you are in control of your money and you just, using the financial advisor. But you got to have some knowledge of, what's going on. And a financial advisor provides areas of expertise that you don't know about. Like I told Dope before, Dope does his own taxes. Why? Because he's a CPA. He keeps up with that. I don't keep up with it. So that's why I have a CPA do my taxes, because I know they're up on the most current tax laws. Same thing with investment expertise. Some financial advisors, they doing it every day, 7 days a week, so they can tell you some of the things that you may not know about. And they help you prepare for things you encounter in the future, which is so important. And the last thing is, look, y'all, and I think a lot of my friends on here can see eye to eye with this last statement. As you get older and your wealth grows, which is great, right? Which is a great thing you want. But your financial situation can become more complex. Remember me say more money, more problems? Got 99 problems and money ain't one. But just think about that, you all. So yes, do it yourself, but you also can use a financial advisor in conjunction. And you can speak to that.
Yeah, I have a bunch of my money with Fidelity, and it's managed professionally. I pay a small fee for them to do that. And the money I talk about with the stocks and Microsoft, that's just a part of what I have. And that's kind of what I don't want to say play with, because it's not, you don't play with any money, but that's money I invest on my own. But the bulk of my money is managed professionally. And the reason I do that is because they offer expertise in areas that I don't know about. So when I need to hear about estate planning or trust, or it's just like I got to start dealing with the required minimum distributions in a couple of years. I will rely on their expertise to help me in those areas that I might not be up on. And they offer a lot of other benefits by being a customer. Well, that's where I get my 3% on everything credit card that I use for miscellaneous stuff. They offer a lot of different seminars on learning about different subjects. So there's a whole litany of reasons why I use a financial advisor, but the main one is because there's so many things that I am not an expert on. And a lot of this all goes together as far as looking at your financial future. There's so many moving parts that you have to manage, and having a financial advisor does that for me. Now, let's talk about, there's a few other DIY investor mistakes that we want to talk about. And we've mentioned these before, but we just thought we'd run through them again. The other one is buying high and selling low. And that's one we talked about. Everybody wants to buy when the markets go up and wants to sell when the market's going down, which is the opposite of what you should be doing. You really should be buying when everybody else is selling and selling when everybody else is buying. And not really understanding the true performance of your investments is another mistake people make. And if you buy a stock that pays a dividend, it may not move as fast as some of the other stocks, but if it pays a healthy dividend, that's part of your return. So you need to take your whole return into account. A lot of people pay too much in fees and commissions. You have to make sure, if you do have a financial advisor, that they're not doing what's called churning, which is just doing transactions so they can get paid as opposed to you. And as we mentioned before, there's no proof at all that a financial advisor picking your stocks will do better than, say, a market index fund or just an S&P index fund. 90% of those folks do not beat the S&P. So keep that in mind. Some people take too much risk, which is most people, and some people take too little risk. And we always say no risk it, no biscuit. So if you don't have some money at risk, you're never going to have a big return. I'm sorry, if you have too much at risk, you have a lot you can lose. If you have too little at risk, you're never going to have a big return. Or it might be the wrong risk. If you're about ready to retire or you need to pay for college, then that money should not be at risk. Another one of the big mistakes is trying to be a market timing genius. Nobody can do that. Nobody knows when to get in, when to get out. Professionals don't. So don't think you do. Another one of the main ones is not having a clear investment goal. You have to know where you're going. You have to have a plan to get there. We've already mentioned failing to diversify. And finally, working with the wrong advisor. Getting someone who's not looking out for your best interest, who doesn't understand what your goals are. And so even if you have a financial advisor, you still need to be financially literate so you can communicate with them, so you can understand the results of your finances, to make sure you're reaching your goal, you understand what you're doing, you understand what somebody else is doing for you, and you can have a reasonable conversation with them about where you're trying to go.
Yeah, that's good. That's good things, though. I just want to add a couple of more, though, that people tend to make these mistakes and not doing due diligence. Like, there are many databases in which you can check whether the people managing your money have the training, experience, and ethical standing to merit your trust. Why wouldn't you check them? Why wouldn't you check them? Ask for references and check their work on the investments that they recommend. The worst case is that you trade an afternoon of effort for sleeping at night. The worst case is that you trade, you end. And the best case is that you avoid the Madoff scheme. So any investor should be willing to do that. Another one I want to talk about right quick, though, is letting our emotions get in the way. Investment brings up significant emotional issues, and they can impede our decisions making. So, be conscious of that. Because what do you want to happen with your assets after you die? Things like that, all these kind of questions raised. So a good financial advisor will be able to help you construct a plan that works no matter what the answers of these questions are that you ask yourself. And last one, though, I just want to say, not taking control of what you can. Now, people like to say they can't tell the future, but they neglect to mention that they can take action to shape it. You can't control what the market will bear, but you can save money, save more money, continue to invest capital over the time, which me and Dope always talk about, dollar cost averaging, and you can influence, your wealth accumulation as a return on your investment. It's the surest way to increase probability of reaching your financial goals. Just wanted to add those little extra ones, Dope.
And Bob, and let's make sure our listeners understand, we aren't pushing one or the other. What we're pushing is financial literacy. So whether you have a financial advisor or not, you still need to understand all the different pieces that are affected, that affect your financial wealth. And so many of us grew up without that not being a part of our lives. That has to be a part of what you do all through your life, is manage your financial life in order to maximize what you have or maximize what you can earn. And it doesn't take a lot of effort, but it takes some, and you have to do it consistently in order to stay on top of things and maximize your wealth.
So what Dope was just saying, we're not financial advisors, but Kitty said, I wanted to invest 10,000 in stocks this month. If I wanted to, what would be your recommendation?
I don't give recommendations.
We ain't buying that. Stop the fuses, Kitty. Good try.
No, but let's explain why. Because if you really think through it, you'd have to look at your entire financial situation, what you're trying to accomplish, what your risk level is, how much risk you're willing to take, what's your time horizon for when you need the money. And so a lot of people want that easy answer of give me a stock that's going to go up by a factor of 10 real soon. But there's a lot more to it than that. It's all those things I just mentioned that have to be taken into account. How much risk you want, what sector would you want to be in, how diversified do you want to be? So it's not an easy answer to say, go out and buy this stock. A lot of people like to think it is, but that's more lottery. That's more buying a lottery ticket. No, this takes work, effort, thought to figure out where you're going, what you're trying to do.
And go ahead.
No, I'm just saying. So you got to go through that to understand what stock you should buy.
Because it's so individualized. That's why sometimes I don't like Susie Orman, because people call in and they give their scenario and she gives answers to it, and people go out and do what she said, what she told that person, but they don't take into account that person's personal situation. And that's what Dote is saying. Dote, I wanted to make another point about risk. A lot of people don't know there's two sides of risk. You have the risk tolerance, you have risk capacity. Risk tolerance is how much risk are you willing to take? But risk capacity is how much risk can you stand? Like, do you need the money in 3 years or 5 years? That's risk capacity, because now you can probably put it away longer. You don't need it until 10 years when you retire. That's risk capacity. So once again, Kitty, that's what we're saying, and definitely we don't want to fall into the bag of giving advice, because this is one of our disclaimers.
And Bob, and another thing is when you talk about those things, there's no right answer when you talk about risk. It's what you are comfortable with. So again, you asking me for a stock. Bob and I agree on a lot of things, but our risk tolerance is different. And it's not good or bad, it's just different. He likes chocolate, I like vanilla. And so it's all of those types of differences between us that make us make different decisions. But we both ended up pretty successful, but we took two totally different routes. And he's much more, much less of a risk taker than I am. And that's okay, because he probably sleeps better at night than I do. But everybody's different. Everybody's situation is different. And you really got to think through this. And we didn't grow up doing that. That was not part of what we grew up doing. So it's different for us. And we have to break out of that paradigm of money not being, and again, I'm not saying money is the end all be all. That's not what I'm saying. I'm just saying there's so many moving parts. There's a lot to understand, and you got to take the effort to understand all the different parts so you can maximize your wealth.
So the bottom line, to do it yourself biggest mistakes, that after all we talked about today, mistakes are part of the investing process. Like what Toad said, no right or wrong. It's a part of the process. No one's that good, even some of the biggest financial advisor gurus in the world, even they have losses and they have gains. Now, knowing what they are when you're committing them and how to avoid them will help you succeed as an investor. To avoid committing the mistakes above, develop a thoughtful, systematic plan and stick to it. If you must do something risky, set aside some money that you are, fully prepared to lose, and then take a chance. Like when we talk about cryptocurrency, that's when we definitely say, only put money in there that you're willing to lose. Now, if you follow these guidelines, you will be well on your way to building a portfolio that will provide many happy returns over the long term, not just the short term, but over the long term. So with that, dope, let's go to the summary and the takeaways. We talked about a lot, as we always do, ladies and gentlemen. And we're going to give you, what are the takeaways from all that we talked about?
First one's on you.
Okay, fine. Not knowing is no longer an excuse. Like what we saying, man, dope, it's not picking on you, but it's just so much information available now. There's so many good advisors out there that you can, check on to check on FINRA if you want to find about advisors, if you want to find about mutual funds. FINRA.org is a great place to start. Financial industry, regulatory industry. So there's no reason for you not to know anymore, So do the work to find out.
Yeah, we talked about this to death today. Take responsibility for your financial well-being. Research, put in the effort, have patience, and use common sense.
And you don't have to be an expert. We just got to make that. You don't have to have a degree in accounting, a degree in investing. You don't have to have a certification as a certified financial analyst. It's just having the patience. And though a lot of people don't research because research takes work. But if you're willing to put in the time, your patience, you're using common sense, you can do this. A lot of this information you could do yourself, and you don't have to have an expert to do it.
And lastly, if you do it yourself, do it right. Okay? You don't want to do it yourself halfway, because you can end up creating a very bad situation. You can put yourself in a hole that you may not be out of, or best case, you just may not maximize what you could have. And so it's okay to do it yourself, because we're not pushing get a financial advisor or not get a financial advisor. That's not what we're saying. We're just trying to tell you the pros and cons. But if you do it yourself, put the time and effort in and try to do it right.
Yeah. That's it. That's our summary of all that we talked about today. Y'all do it yourself. Investors' biggest mistakes. We hope that was very helpful. A lot of comments out there. Kitty said, willing to lose it as it's just sitting there with less than 1%. At least you know you're making 1%.
Yeah. And that's the thing, Kitty. Whatever makes you happy, that's what you roll with.
Right. You know, but just want to thank everybody. Do our roll call. Maddie says great information, nice show. Thank you once again, Maddie. And hey, Now, what's up? Thank you, Now, giving us a wonderful shout out. Thanks, Now. Good stuff, very informative. Joanne Skinner, thank you so much, Joanne, for your comment. We really appreciate that. Kitty, my partner and the greatest Toastmaster in the whole United States of America. Angela Grubb, what's up? Once again, great information. Last point is my greatest concern. Oh, what was that last point? We'd like to know what that was. That resonated with you, Angela. And a wonderful sister Nolia, thank you for your information, human resource information. It is so great. My sister Gloria on, thank you, Gloria. Rodney, thenoteexperience.com, senior. Hey, look, Rodney put out there when we were talking about take your time, do it right. He said we should put on the SOS band when we were talking that. Take your time, do it right. You so old school, Rodney. Stop it, man.
I love it. I love it.
And my sister Linda, thank you as always for being out there with us. We love you all. We're here next week. This was our 104th show. Next week will be 105, and we'll be right here Thursday at 8 p.m. Next week will be the 15th. Look forward to seeing you all. Well, not seeing you, but hearing from y'all. Don't have a good one. Another great show. Thank you for your wonderful information, my brother.
Same to you, good brother.
I'm still learning from you, man.
And we're learning from each other.
Peace.